Hello and welcome to this week's weekly market recap for the week ending, let's see, February 14th. Wow, middle of February already. February 14th, 2025. It's a pleasure being with you again. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. Interesting week last week. We saw the S&P 500 climb back up very near an all-time high, got within about 4 or 5 points before settling back at 61.14. I think that all-time high was up around 61.28. So intraday we got up, I think, 61.23, 61.24 on Friday, but then failed to hold it, ended up pulling back. So we did have a failed all-time high close on Friday on the S&P 500, but still it was nice to see the market back up. So we keep trying to get through, but it seems like, the under the surface signals aren't strong enough, at least not yet, to power us through. I did see some of the growth stocks bouncing back on Friday, which was good news for the market, but we're going to need to see that continue on any kind of breakout to really feel like it's got staying power. And that's been one of the problems so far, as we've seen rotation away from many of the growth names, especially the large cap growth names. And so if that returns, then I think that would be more bullish, but without it, I think we could continue to struggle here in the near term. Also, we're flipping the calendar. We're moving to the second half of the first quarter this week. So that normally carries action. It's not quite as bullish as the first half of the first quarter. So we'll see what happens. A lot of times we do see rotation moving more towards staples and real estate and utilities. Utilities best month of the year is March, seasonally. So we got that coming up in just a couple of weeks. So when money tends to rotate more toward those areas, that tends to not be a very good thing for the market. And that is the tendency for the second half of February. So we'll see. Inflation. We got another CPI report out. The core CPI for the month of January came out on Wednesday. That was higher than expected, came in at 0.4%. The market was expecting 0.3%. But the next day, the core PPI also was higher than expected. But actually, I think at the core level, it may have matched. I think it was higher on the headline number. Anyhow, I'd have to go back and double check. But one thing that was really interesting is we saw the yield, the 10-year Treasury yield, jump to the upside by about 10 basis points on Wednesday after the core CPI report. But then Thursday and Friday, we saw the 10-year Treasury yield fall back below where we were when that core CPI came out. So what that tells me is that the bond market doesn't seem to be as concerned about inflation as the Fed. And again, I've talked about this over and over again. I believe they're going to lower rates this year again, but they want to wait and see. I think in congressional testimony this past week, Fed Chief Jay Powell talked about the fact that the Fed wanted to see more progress towards getting toward the 2% target before they will consider lowering rates. So based on the reports we got this past week, it's not under consideration. That'll be something to watch, though, in the next couple of months, depending on which way inflation goes with these monthly reports. And looking at some other factors, we always like to look at the non-farm payrolls report. That gives us a little bit of an indication of wage inflation and where we stand there. So we'll just keep an eye on it and keep going. But for now, it certainly seems to me, with the stock market and with the bond market, inflation is not nearly as big a concern as what the Fed's talking about. Gold went up almost to $3,000 an ounce this past week, got up to about $2,970 or something in that range, maybe just shy of that, before settling back a little bit. But gold getting close to 3,000, it has continued to perform well in 2025, extending a pretty good year in 2024. It has outperforming the S&P 500. It has for about the last 13 months or so. Not by a lot, but it has outperformed. Still, the long-term relative strength line on gold is not great. So when the short-term strength ends, or if it ends, just beware that long-term relative strength line is not great. Anyway, well, let's go ahead and take a look at what happened last week. We'll take a look at some of the indices. So the NASDAQ 100 up almost 3% last week. So that was a good, nice rebound, getting back up close to the NASDAQ's all-time highs as well. Transportation. So all of a sudden, remember, 15,750 was kind of a key area of support on transportation. We jumped almost 3% last week. That was 460 points. And now we're quite a bit away from that 15,750 support area that I think is pretty important to hold, not only in the short term, but maybe more intermediate term. And we are in an uptrend in the transportation index. If you look at a long-term chart, you'll see clearly we're in an uptrend. Doesn't feel like it on a daily chart because we just seem to keep going up, down, up, down, up, down, not really showing any kind of trend. But if you look at a longer-term chart, transports are just fine. They've just been lagging. S&P 500 up 1.5%, and that was about it in terms of strength. You can see the Dow rising about 0.5%, 44,546. Still got to get back up through 45,000 in order to get to the all-time high there. Russell 2000 and mid caps lagging the most, not only last week but recently. The Russell had gotten up into the 240s. Remember, at recent highs. That's not actually. I think that was the all-time high, but it had gotten up to like 242. 243, I'm not exactly sure. Anyhow, we're still hovering back down at that 226 level in this, I want to call it 225 to 230 range, but we've gone below 225 a couple times now, so maybe it's 220 to 230, but it's still just kind of staying down in this range, not really participating as well as the NASDAQ and the S&P 500. And I think a lot of that has to do with interest rates, the fact that right now the Fed's kind of gone on pause with lowering rates. We saw some great outperformance by small caps and mid caps when the rate cuts were on the table, when they were happening, and when the Fed was talking about continuing them. As soon as that talk flipped, so too has the relative strength in both small and mid-sized companies. All right, how about the sectors? Actually, let me go back here. I think thought I had this pulled up. Well, maybe I didn't. We'll view all of them, just so we can get a good look here. All right, so on the sectors, we'll look at it over the last week or so, and you can see, let's get it in order here. Technology, communication services, two of the three really aggressive areas led last week, and that's what I was talking about. It was a good showing in some of the large cap growth names, which is what we want to see. If we want to turn more bullish, and get away from this cautious phase, you want to see a breakout and you want to see leadership from these areas. So we got the leadership, haven't seen the breakout yet. So maybe next week, maybe we'll get a surprise to the upside. I'm still pretty cautious here in the near term, but hey, up is up, and that's what we saw this past week. Down at the bottom, you can see the two groups that did not participate in last week's rally. Healthcare down 1%, and then also financials just fractionally down. Moving on to the S&P 500, let's take a look at this chart. So here's the daily chart, and you can see we made a big run all the way through November and into the early part of December, and it's just been tough since then. I mean, you might consider this kind of a weird-looking cup with a handle still kind of going out. That, to me, it doesn't quite look like a rounded cup. It just looks way too jagged for me, but it's still kind of the same thing. I mean, we went down, held on to the gap support from the election, and then moved back up, basically set a new high, although we really didn't go through with much gusto. And now we've just been going sideways. We're in a sideways consolidation phase. But maybe this week, like I said, maybe it makes a breakout. Markets are closed today, Monday, but they will be open the next 4 days. So we'll have a holiday shortened week, and we'll see whether or not we can get this breakout. The NASDAQ 100 moving up, and I don't think this one closed at the high. Let me just double check because I know it was threatening it. 22,097, and we closed at 22,114. It was an all-time high close on the NASDAQ, so my bad. The intraday high was 22,133, and the high was 22,139. So we got an intraday high as well. But my point is we didn't close above that intraday high that we had seen back in mid-December. So right now, I kind of view this, even though we technically do have an all-time high close, still kind of just testing where we were back in the middle part of December. So it'd be interesting to see whether technology continues to lead, because if it does, there's a pretty good chance that we're going to see this breakout on the NASDAQ next week. Small caps. So here was the high in the small caps back in November, and look at where we are. So that's that relative weakness that I was talking about earlier. We still see it. I think we're probably going to continue to lag on the small caps until the Fed decides that it is time to start thinking about cutting rates again. And for those who don't think that cutting rates is a good idea, I'm not talking about cutting rates to zero. I don't think the market needs that. And I think that would be a big problem for inflation to do that. But I do think in the short term, we could see the Fed funds rate come down another percentage point. Wouldn't surprise me, maybe even two, which would help a lot of the small companies, mid-sized companies around the country, because the small banks would then be able to borrow cheaper. And when they can borrow cheaper, they're going to be more willing to lend, increases their spread. They make more money and make capital available for many of their clients. So I don't think the Fed wants rates to stay up high for very long. Obviously, they're still believing they need to fight inflation. Market doesn't seem to agree with them, but whatever, that's what they're doing. And so I think until they again flip. Now, last time they said they were going to start fighting the economy, that they were done with their fight in inflation. They thought things were heading where they wanted them to head. That was, 4 months ago before they flipped one more time. But until they get back onto that bandwagon of looking at rate cuts, I think we'll probably see small caps continue to languish. But I don't think that's going to last throughout the year. I really don't. I think we will start to see rate cuts, or at least the talk of it, in the second half of the year, maybe even before that. I'm not convinced that we're going to continue to see these higher inflation numbers, but I don't have a crystal ball, so we'll watch and see what happens. But I do think later in the year, we will see small caps pick up in terms of relative strength versus a lot of those large cap names. Transports. So here are the transports, and you can see this 15,750 area. This is what I've been talking about last 4 or 5 months. I mean, I don't know how many times we've bounced off of it now, but quite a few. But look at what we've done here over the last week and a half to 2 weeks. Nice little rally back. Breaking back out above about 16.9 would be great. And what we could see is we could see money rotate. Now that the major indices are ready to break out, we might see money rotate away from technology and some of those names as we move into the second half of this first quarter. And maybe transports and some other areas that have been beaten down. Maybe they start to play catch up. I'm just, making a few assumptions here. We'll have to watch to see if that actually happens. But one sign would be a breakout above about 16.9. All right, within transports, I thought since transports are starting to move, let's take a look at what's going on here. Airlines. Okay. Airlines have had a huge run, and they started in September, broke above the 50-day moving average in September, never really looked back. And now we're getting up here. It looks like we got some negative divergences. PPO now trying to turn negative. Actually, it's just barely positive right now, looking to turn negative. And I don't know, it looks like the market's kind of rolling over. I'd watch 220, 225 area. This group I'm a little concerned about, partly because of the way the chart looks, but also because of the seasonality. This is a very interesting chart. Since the secular bull market was confirmed when we broke out to new highs on the S&P 500 in April of 2013, this is the last 13 years of how the airlines have performed by month. And what you'll see, let me kind of zero in here just a little bit. What you're going to see down here at the bottom, there we go. There. Down here at the bottom, look at September. Over the last 13 years, look at September, October, November, December, January, and February. Those 6 months are strong. And if you add those numbers across, you're going to get close to 20% average return, average 6-month return for airlines over the last 13 years. So there's definitely a tendency for airlines to do well September through February. And I just showed you the chart. I mean, that September is when we broke out above the 50-day moving average, just as we went into the beginning of September. We were in this downtrend. We broke the downtrend literally as we were moving into September, and we've had 6 nice months. Now we get the next 6 months, which when you look at this, March, April, May, June, and August, 5 of the next 6 months have averaged negative returns. And so only July has a positive return. If you add those across, you'll get somewhere around 5%, like a 5% decline, 4 or 5%. So the average return September to February, almost 20%. The average return from March to August, minus 5% or minus 4%, whatever it is. So really is like 2 different seasons for airlines. So now we get the bad 6 months for that group. And we'll see whether or not whether we follow history or not. But that does make me a little bit more nervous for sure. All right, here's the railroads. Railroads have been going sideways all year. But when we have seen rallies in the transports, a lot of times it's been because of the railroads. And so these last couple of weeks, like I've been talking about here in February, transports have been rising, and partly reason for it is that we're seeing railroads perform so well. So breakout above about 35.20 or so would be big. But of course, the bigger one's going to come if we can move back to 52-week highs. And that's not going to happen until we're up in the 3600s. And then trucking. Truckers started February pretty strong, then kind of just going sideways. This looks like a flagpole and little flag to me. So I would expect a move to the upside. Now, the last time we did this, though, you can see we had the same thing. We had this flagpole upside, and then we had a false breakout, and then right back down we went. So we want to get a breakout that sticks. So let's get it closed back up above 1850, 1860. And at that point, I'd start to feel pretty good that truckers may run back toward that 2050 area, which is the November high. At least we'll be in that sideways consolidation range. All right, for those of you that are new to Earnings Beats, if you go over to earningsbeats.com, this is our home. You can sign up for a free 30-day no-cost trial by clicking that button. We have a huge event later today, starting at 5:30 p.m. Eastern Standard Time. That is our draft, what I like to call our draft. This is where we fill out our portfolios. So the portfolios that we track, where we've seen outrageous outperformance over the past 6 years, 6+ years on the model portfolio, and about maybe 5 3/4 years, something like that, on the aggressive portfolio. The new stocks are going to be entered into as of Wednesday's close, but they're going to be announced today. So if you're interested, I mean, we've crushed the S&P 500 the last 2 quarters. We've crushed the S&P 500 over the last 5-6 years since we started it. It's just our methodology on how we pick stocks and the things that we think are important at Earnings Beats. And I'm going to go through those methodologies and those strategies tonight when we unveil the 10 equal weighted stocks that will go in both of those portfolios along with our income portfolio. So make sure you check that out. If you click on this link, it'll bring you to the page right here. I mean, you can see here, I'll just show you a brief history. If you invested $100,000 back in November of 2018, it would be worth $222,000 right now. If you had invested that same $100,000 in our model portfolio each quarter, when we change, if you just stuck with it and just keep reinvesting, you'd be at $405,000. That's pretty big outperformance. So if you want to learn more about that and how we do it, first of all, go to our website and click on the link that takes you to this page, this landing page, and then join us. You can join us simply by being a 30-day trial member. You don't have to be a paying member. So we'd love to have you. Check out our style and our strategy. I think it'll help in your trading. So looking forward to seeing you. Now, if you're on your mobile device, then on your screen right now, there's a QR code. If you scan that, it'll bring you on your mobile device to this page. So make sure you check it out. We'd love to see you later today. All right, a couple more things just to wrap this thing up. I did publish a couple articles over at Stock Charts. If you don't follow me over at Stock Charts, let me show you how easy it is. Just go over to Stock Charts under Articles, click on Articles, and then you can go, here's actually the 2 articles I wrote. There haven't been any other articles published there. But if you go down to Trading Places right here, you can find me here. Also, if you want to follow my blog, in other words, I don't know when I'm going to post. I don't post regular times. Usually I post on an article on the weekends. But simply put in your email address and hit that submit button. And Stock Charts doesn't use your email address for anything else. You're not going to get spam or anything like that. They don't sell your email address. So just type it in there, and then anytime I publish an article, it will automatically be sent. That's a free service at Stock Charts. It's pretty cool. So make sure you sign up for these articles. Yeah, put your email in and you won't miss any. They'll be sent directly to you. All right, so let's finish this thing off here with a couple of stocks. Now, this was one of the stocks I featured in one of those articles. I wrote an article talking about there were two really good earnings reports. This was one of the two I discussed. Coke came out. They beat top line easily by like 7%. They beat bottom line. I think it was, going off of memory here, but I think it was 55 cents versus 51 cents. So an easy beat on the bottom line for Coke, and you can see the big gap up here off of this downtrend. So gapped back up, through it, nice volume for a few days afterwards, where we closed almost on the high, 3 straight days in a row. That tells me there's a lot of accumulation, taking place on Coca-Cola. And interesting thing here is I believe, nope, I didn't pull it up. Let me pull it up for you. If I pull up Coke seasonality, check out, well, first just go back down, go to the last 13 years, which is during the secular bull market. But look at the 2 best months on Coke, March and April. Look, check your calendar because it's mid-February. March and April right around the corner. So Coke just came out with a great earnings report, gapped up, broke its downtrend, and now we're getting ready to head into the 2 best months of the year seasonally for Coca-Cola. So this is one that I'm considering. I haven't picked any stocks yet. I'm going to actually be doing that after this video is done. Rest of the day, I'll be going through what I consider my war room for the draft and trying to find 10 best stocks I can for our portfolios. But Coke may find its way into our portfolios based on the seasonality, based on the earnings report it came out with, and the improvement of its chart technically. Now, where I'm going to get all of my stocks? Well, we've always drawn them from our strong earnings chart list. And this is our strong earnings chart list, and I've put it in order of Scooter, and I've also changed the period to 3 months so that you can see the stocks. These are, the Scooter score is the stock chart's technical rank. It's a relative strength ranking. And so it goes from 0.1 to 99.9. So APP is at 99.9. So it is the top rated stock in its asset class. And you look at the chart and you'll know why. I mean, that thing, we can pull it up. It's going straight up. But there's the latest earnings report. Another big gap up there. But you can see the last 6 months has just been just outrageous. Stock's gone from $60 to $500. Now, this is a candidate for our portfolios. The question is, how overbought do you want to buy it? And that could be a little bit of a problem as far as the portfolios go. Got to give that some thought, because if the stock goes through just a couple of months of consolidation, our quarter's over. So if they're too overbought, it's possible that we could run into some problems simply with normal consolidation and profit taking. But I can tell you, Palantir was in our portfolio last quarter. It gained 101% over the last 3 months. So if you want to know how to beat the S&P 500, find stocks like Palantir, a growth stock that has a massive quarter like this. Because that right there, because it's 1/10 of the portfolio, that adds 10 percentage points to our performance. Just one stock. Now, that's unusual. You're not going to get too many stocks that go up 100% in a quarter. So I'm not trying to make it look like that's what we do all the time. But when you do get these kinds of stocks, it makes a big difference. We had Reddit in our portfolio last quarter, up 49%. We had Doximity, 48%, higher there. We had Tapestry, up 52%. So a lot of these relative strength stocks are stocks that we picked 3 months ago. And so this is going to be the process again later today, is to go through all of these stocks, take a look at what we think are the best candidates, try not to pick them all from the same group. I mean, you don't want 10 software stocks. You do last quarter, but you wouldn't want them if, software takes a big hit. For instance, you don't want to have all your eggs in one basket. So we do try to split them out and try to get stocks in different industry groups, just to balance out the risk somewhat. But these, I always say we're not registered investment advisors. I'm not giving advice. I don't give recommendations because I'm not licensed to do that. We educate. And so for our purposes and the way we track it, it's just showing how our strategy has worked over the last 6 years. Members are it's completely up to them, whether they want to trade them, whether they want to buy and hold them for the 90 days, whether they just want to ignore them, completely up to our members. But we do it just to try to help educate. Anyhow, that's it for today. I hope you join us tonight. Again, go to earningsbeats.com and make sure that you check us out and check out this top 10 stock picks. But until next week, hopefully see you later today. But have a great week ahead, and we'll be back next weekend to do it all again. Happy trading, everybody.